Well, Thorndike's The Outsiders, it's one of those books you see on pretty much every serious investor's bookshelf. It's become a bit of a Bible in that world. But the real question is, does it actually hold up to academic scrutiny? Well, today, we're going to put on our professor's hat, really dissect its core blueprint for success, and see where the cracks might be. Let's get into it. So, here's our game plan. First, we'll tackle the myth of the charismatic CEO. You know, the one we always see in the movies? Then we'll lay out the outsider's playbook, this radically rational blueprint. After that, it's time for a proper critique from a professor's point of view. We'll then see this blueprint in action with some real-world examples, and finally, we'll wrap it all up with some key takeaways for you. All right, part one. Let's just jump right in and start challenging that story we've all been sold about what great leadership is supposed to look like. It is time to blow up the myth of the visionary CEO. So let me ask you, when you hear ideal CEO, who pops into your head? Seriously, take a second. Picture that person. Are they on a huge stage giving a keynote? Are they a media darling? Maybe some kind of visionary who just seems to bend reality to their will? Yeah, just hold that image in your mind. Because right from the get-go, the book hits you with this incredible contrast. On one side, you've got the myth, that charismatic, PR-focused empire builder who's always in the news. But on the other side, that's the outsider reality. These folks were often reclusive, almost pathologically obsessed with the math, and totally driven by creating real value per share, not just making the company bigger. This tension, right here, is the heart of the whole book. And this is the central question Will Thorndike poses. What if the best CEOs weren't the famous ones? He just strips away all the noise, the charisma, the headlines, the grand visions, and he zeroes in on the one metric he says truly matters: long-term performance per share. And what he found was this small group of CEOs who just absolutely destroyed the market, but they did it so quietly, so unconventionally. So here's something to chew on as we go through this. Think about your own company, or one you really admire. Is the main goal there to just get bigger, more sales, more people, bigger offices? Or is it to become a more efficient economic engine, squeezing more cash out for every share? The answer tells you almost everything you need to know about that company's real philosophy. Okay, so if these outsider CEOs were tossing out the standard leadership playbook, what did they do instead? Well, that's what we're getting into now. We're going to break down their very specific and surprisingly repeatable framework. This wasn't just luck. It was a blueprint. All right, this right here is the absolute key to everything: capital allocation. Now, I know it sounds like some dry MBA term, but it's actually super simple. A company makes cash. What does it do with that cash? Does it build a new factory? Buy a competitor? Buy back its own stock? Thorndike's big argument is that making these decisions is the single most important job a CEO has, period. The outsiders all shared this really distinct way of thinking. First, they didn't see themselves as managers running an operation. They saw themselves as investors deploying capital. Second, they pretty much ignored fuzzy accounting profits and were obsessed with free cash flow, the actual hard cash the business spits out. And third, they were just ruthlessly rational. No emotional attachment to a business unit or a strategy. If it didn't make mathematical sense, it was gone. And this way of thinking led to a powerful three-part toolkit. First, share buybacks, but not the way most companies do it. They only bought back stock when they thought it was genuinely a steal. Second, they ran these incredibly lean, decentralized companies. This freed them up to focus on the big picture, on capital allocation. And third, they were super disciplined about mergers and acquisitions, buying when things were cheap, and even selling divisions when prices got frothy. You know, there's this great analogy from the philosopher Isaiah Berlin that fits perfectly here. He said there are two types of thinkers: hedgehogs and foxes. The hedgehog knows one big thing, one grand theory, and applies it to everything. But the fox knows lots of little things and adapts to reality on the ground. Well, these outsider CEOs were classic foxes. They did whatever the math told them was the smartest move at that exact moment. Okay, so we've seen the blueprint, and it sounds pretty compelling, right? But now it's time to really put it to the test. Let's put that professor's hat back on and take a hard, critical look at the strengths and the potential blind spots of this whole outsider model. So if we grade this like an academic paper, we get a really interesting scorecard. On the plus side, the model is brilliant at solving what's called the agency problem. It gets CEOs and shareholders pulling in the exact same direction. It's also fantastic real-world proof of some important financial theories. But, and these are big buts, we can't ignore the weaknesses. The most glaring one is survivorship bias.
I mean, it's a classic mistake. The book only studies the winners. For every CEO who succeeded with this model, how many tried and failed? We have no idea because they're not in the book. Then there's what I call the operator gap. The book makes the CEO sound like this brilliant investor, but it kind of glosses over the incredible operational skill you need to generate all that cash in the first place. You can't allocate cash if you don't have any. And finally, you really have to question if this model, which works so well in mature, stable industries, is the right fit for, say, high-growth tech, where you often have to bet the farm on innovation.
Theory is one thing, but let's see how these ideas actually work or don't work in the real world. We're going to dive into a modern success story that feels like it was ripped straight from the book, and a cautionary tale of what happens when you do the exact opposite. If you're looking for a modern-day spiritual successor to the original Outsiders, you have to look at Mark Leonard and Constellation Software. I mean, the guy is famously reclusive. He almost never talks to the press, and he's built this massive, decentralized empire by acquiring hundreds of small, niche software companies. It's the blueprint in action. And the results? Well, this number really says it all. Over 10,000% since its IPO in 2006. That's not a typo. That is the incredible power of compounding value by just rationally and patiently reinvesting cash year after year after year. Now for the complete opposite. Let's look at General Electric during the Jeff Immelt era. This is just a textbook example of what the book calls the institutional imperative. That's the tendency for companies to just copy their peers and follow fads instead of thinking rationally for themselves. I mean, when you put these two strategies side by side, it's just night and day. Constellation stuck to its decentralized knitting, making smart, rational acquisitions, always with an eye on intrinsic value per share. GE, on the other hand, chased whatever growth story was popular, bought assets at the very top of the cycle, and used buybacks to make their earnings numbers look better. They focused on telling a good story, even as the math of the business was falling apart. Okay, so we've deconstructed the myth, we've broken down the blueprint, and we've seen it in action. For this last part, let's make it personal. Let's translate these big ideas into some practical advice you can actually use, whether you're a CEO or not. If you're an entrepreneur or a manager, I'm talking to you. Stop celebrating growth just for growth's sake. Start measuring efficiency. Instead of bragging about total revenue, look at your profit per employee. Instead of just buying things, measure your return on invested capital. Adopting this per-share mentality forces you to focus on creating real value, not just getting bigger. And if you're an investor, you can actually go hunting for these outsiders. Start reading the proxy statements. See how the CEO gets paid. Is it based on metrics that are easy to fudge, or is it tied to actual cash flow and return on equity? And look for those CEOs who aren't afraid to admit their mistakes in their annual letters. That's a huge sign that they see you as a partner, not just as an audience. And, this applies to all of us in our own careers. You are the CEO of you Incorporated. Your time, your energy, that's your capital. Are you investing it in skills and projects that will actually compound your value over the long run? And be a fox. Be willing to adapt and move your skills to a new area if the industry you're in is shrinking. At the end of the day, this is the core philosophy. It's a call to think for yourself. It's about rejecting that herd mentality that drives so many bad decisions and having the courage to look at the numbers and make the rational choice, the one that maximizes long-term value even if everyone else thinks you look crazy in the short term. So I'll leave you with one last big question to think about. The outsider model really celebrates this quiet, rational allocator. But when you look at some of the most dominant, world-changing companies of our time, companies like Tesla or Amazon, they were built by exactly the kind of charismatic visionaries the book warns us about. So does that mean that in today's world of insane technological change, the visionary hedgehog might actually have the edge over the rational fox? It's definitely something worth debating. Thanks for joining me.